Everybody. Beer Money Sundays. Try doing one of these every Sunday, 2 p.m. Eastern, 11 a.m. Pacific time. Thank you for being here. I see a lot of people in the comments and giving me that heads up on the audio. So I appreciate that. Great conversation for you coming today. Great information with value versus growth stocks and in 2021, and what I think could be one of the best opportunities for next year. Okay, we've seen a lot of the value names lag this year from that huge growth in the growth stocks, right? The tech names and some of those other consumer discretionary and other growth sectors. But I think that could be about to turn in 2021, and really history is on the side of value. So we've got some great information coming for you. Thank you for being here again. Thank you for the heads up there in the comments. And Nation, one of the most common questions I get on the channel is is it worth your time to pick stocks? We talk a lot about picking stocks and this value versus growth kind of idea that we're going to be talking about today, and individual stocks. So can you, does it make sense? Can you really pick stocks and can you make those higher returns? And, I just got to point to some of the results that we've seen on the channel. Just this last week, we saw a huge surge in Snapchat stocks, right? Snapchat was up something like 44% this week. It's I think, what is it, 75% since the last month that we recommended it. Pinterest was up 48% just this last month, and in fact is up something like 176% since recommending it in December. So you can pick stocks, but it takes that kind of deep analysis. Okay. And some of the analysis that we do here on the channel, people like so Vincent made $10,000. He said. Got another one comment this week by Ambrose said he's up 100% on Pinterest. And you can pick stocks. You can get your use those investing strategies that we talk about on the channel to beat the market. But it takes more than just picking stocks that have been going up lately and riding those up. Okay, you have to get that deep analysis that we talk about here on the channel, that we're going to talk about here today with this value versus growth stocks, and then you come down from that into individual stocks. Okay, so all you out there in the Bowtie Nation, I love that top-down analysis, right, where you're finding those long-term trends. Whether it be by sector, whether it be those unstoppable forces like robotics or AI or EV or something like that, you find those trends that are driving all the stocks within a sector or within a group, and then do your analysis down from there to pick specific stocks from there. And so today we're going to look at value versus growth. We're going to look at which might outperform in 2021, and how to set up for that, and then into individual stocks for that. So again, great topic for you today. Going to do some question and answer at the end of the live stream here. So if you got a question, just make sure you put it in the chats there, and put a question mark there so I know that it's a question when I come back to those. Just real quick, highlighting some of last week's videos. Started our 2021 portfolio there on StockCard. It's free to follow. You can at any time you can sign in there to StockCard and start a free account if you want. Follow the portfolio, and it's going to give you updates. This is why I started using StockCard for our portfolio instead of M1 Finance like we've used in the past. But if you're following the portfolio, then you can follow it, and it's going to give you an update each time I add a stock or sell a stock from the portfolio before the video comes out, right? So generally I will add a stock or sell something the week before the video comes out. I'll produce the video and all that, and then it'll come out. The video will come out the next week. If you're following the StockCard portfolio, you'll be able to see that before the video comes out. So really cool new feature that we're going to be using for 2021 in that Bowtie Nation portfolio. If you do end up subscribing to StockCard, use the promo code Bowtie Nation, all one word and all lowercase, and you'll get an extra 10% off there. So I actually was able to negotiate that an extra little discount for our community there on StockCard. Also talked about insider trades on Friday. A really cool video that I like to follow a lot of times. Those insider tradings from the management and the board of directors. This week coming up, we've got a couple videos coming at you. A really interesting ESG video tomorrow, talking about some of that ethical and socially responsible investing that honestly I avoided for a long time. I mean, I thought, okay, why should I limit myself on what I can invest in as far as, if you're investing in ESG themes or ESG stocks, then you're not investing in a lot of the vice stocks, casinos, tobacco, alcohol, companies around that have some controversies around them, or you're favoring some other stocks that just have missions and value statements around that ESG theme. And I thought that was going to hurt my returns. And researching for the video and researching this, I actually found out it was just the opposite. A lot of times in these ESG themes, you can actually get a higher return, higher dividend yield on a lot of by following that theme. So going to be talking about that tomorrow. That's going to be pretty cool. Another highly requested video coming at you on Friday, I think it's scheduled, is how to pick an ETF, right? So if a big part of my strategy is investing maybe 50-60% of my money in a core group of ETFs, right, that are going to give me a broad exposure into all the asset classes, stocks, bonds, real estate, as well as a lot of the other themes I'm looking at. And then a small portion, maybe 35 or 40% of my money goes into those individual stocks, right? So I wanted to cover really what I look for in an ETF, some of my favorite ETFs that I invest in, and kind of give you something on that. But I want to get to today's topic because, again, I think this could be a huge opportunity for next year as we head into 2021 in that transition from growth into value. So I want to talk about, first, what are value stocks, what are growth stocks, just some real basic stuff really quick, but then look at some of the historical performance of value versus growth. And it's really interesting how that history has kind of broken down, pre-2008 and then these last 10 years, and why I think it could revert back to that historical trend. So what we're going to do, so first, value stocks are just typically those stocks with the lower price multiple stocks, right? But it's more than that too. It's going to be typically those larger companies. They're typically going to have higher dividend yields, right? Because they're larger, more established companies, older business models, older sectors. And so they're going to be able to pay, they can have those more established cash flows, and they're going to be able to pay out dividends like that. And they've typically also have better balance sheets, right? They've got, growth stocks that are loaded up on debt. They've, debt to equity is generally much higher. So, value stocks are just that longer term idea of larger companies, dividend yields, and good balance sheets. And then growth stocks are going to be kind of the inverse of that, right? Higher growth names, and typically it's also within sectors like, tech, your communication services, which is going to be a lot of your internet names, right? Internet services and the FANG names and things like that. And the historical performance in this is really interesting. Let's look at another chart here. You look at this chart, and this is actually the years where value beat growth. And this is, okay, so the green bars here, maybe a little bit hard to see, so I'll explain this. The green bars are going to be the years where value beat growth, and by what percentage, right? The blue bars on the bottom are the years where growth beat value, right? And that by that percentage. And you can see that all the way up until about 2008, which is, that last section there on the right, all the way up until that point, value perennially beat growth almost every year. There was few years here and there that where growth would come out ahead, but value typically beat growth by a large margin, right? And what we're talking about is just those value stocks, those value sectors that we'll look at, something like utilities, healthcare, energy is often included in that. Those value sectors, those value stocks with the lower PE multiples and lower multiples, right? And over this long term, since 1928, in fact, value stocks have beaten growth by 4.5% on average. Okay, but what you see in this graph and what you'll see in these next couple of graphs is since 2008, really, it's really reversed. Okay, so since 2008, 12 years now, only 3 years has value beaten growth. Those other, the rest of that time, growth stocks have actually outperformed, and some years by a pretty wide margin. And what we see though is if we actually look at the returns, and this has been a huge theme in the market, that how growth has been outperforming over these last 10 years. But what we see is if we actually look at the returns here, it's not so much that value stocks have been underperforming. Okay, what we have here is on the left is, okay, the dark blue line is the the annualized return over the past 10 years for value stocks, right? The very far left. The turquoise line next to that is the annualized return since 1926. So what we find actually, over the last 10 years, value stocks have actually performed about the same as they did since 1926, right? Annually, you've got about 13% annualized return over the last 10 years, which is pretty darn close to that 12.7% over the many decades since 1926. But what we've seen over these last 10 years and why growth is now outperforming value stocks is, look at this other side of the chart here on the right. The dark blue line, again, the 10-year annualized return on that index, the growth index, and then the turquoise is since 1926. So over the last 10 years, growth has actually just zoomed higher, 16.3% annualized growth, right, in that index, versus 9.7% previously. So if you look at the two turquoise lines there, since 1926, value stocks have actually outperformed. They've returned that 12.7% annual return versus the 9.7% with growth. But just over the past 10 years, I mean, growth has just really come into its own with that 16% return. So one is that it's not so much that that value has fallen out of favor, but the growth has just come up so fast and so quickly. And one more chart to show you here for this for the analysis is this difference. The cumulative difference in returns. So here, this is the difference in annualized total returns over each 5-year period, right? So a rolling 5-year period. The difference in returns, and on the above zero is where value is outperforming, right, and below zero is where growth is outperforming, right. So you can see a lot of this period, it only goes back to 1985. A lot of that period, value outperformed, and by quite a bit. Okay, so through 2005, value was outperforming annualized total return by almost 20%, right. So that's over a 5-year period. Value outperformed growth by 20% over that 5 years. And then since this 2008, we started to see that kind of a regime change in the markets where growth really accelerated. And you can see clear on the right here, 2020, value has underperformed growth on an annual basis by about 10% a year over the last 5 years, which is really amazing. That's going back to about 1980 actually. That's pretty much the second, only in 2000 here. If you look at this chart, only in 2000 did we see growth outperform for so long and by so much. So obviously, that tech bubble, the tech stocks, growth stocks were zooming ahead. But if you look at this chart and you just look at the historical precedent from value versus growth, I mean, that could change very quickly and very abruptly. In 2000, where we had growth outperforming value for that 5-year rolling average, 12-13% a year, then it changed so much into all the way through 2005. So that's really kind of what we're seeing heading into 2021. And now I want to talk about why I think this regime could change back into that historical precedent, and why we could see value outperform in 2021 and beyond, and then how to position for that really. So just because growth has been outperforming for the last 10 years doesn't necessarily mean that it has to beat the next year. It's going to change eventually. Okay, just like we saw the difference in cumulative annualized returns. That graph, sometimes you get growth outperforming for a few years, sometimes you get value outperforming for a few years, but that transition does come eventually. So what I want you to think about is yeah, okay, it might not happen immediately, maybe not even first half of 2021 or into the second half, but eventually those value stocks are going to come back. And a lot of this is just based on factors like changes in the economy, changes in those traditional value sectors. Okay, one of the reasons why value has really underperformed over the last year and over the last 10 years is because of those typical value sectors like financials, like energy. Financials with interest rates at rock bottom prices and really that yield curve flat, then it's very hard for the financials to make money. Okay, the banks they're gonna lend out the money, on longer term rates and pay rates on their deposits at those shorter term rates. But when the yield curve is flat, there's just no difference in those rates, right? So they're not making that money. They're not making the difference in the rate spread. Also for like insurance companies within those financials, within the financial sector, then the insurance companies are having to are investing all that cash that they have set aside to pay those premiums, and they're just not making any money on it, right? They have to invest in super safe investments, so they have that cash available when they need it, and they're just not making any kind of a return on bonds and other very safe investments. Energy, a different story, but also very much hit since 2014. When we had the oil crash back in 2014, and of course this last year in 2020 with the demand side of it. So those two traditional value sectors have really hurt value investing and value stocks over the last year. There's also kind of that early stage growth IPOs that are just massive companies coming to the market, a lot of sentiment behind those. But this is one of the main reasons why I think value investing can start outperforming in the years ahead. Okay, one of those is that IPO market. And if you notice, I come from a venture capital background, right, where we used to analyze private companies for private investors. We would invest the money in those stocks before they IPO'd, before they became stocks, really, right, into the public markets. And typically we were looking for companies that 250, $500 million market cap or so, maybe even less, maybe in a 100 million market cap. We'd invest in those, and then we would look to IPO those names into the market or sell them off to another company when they reached that 500 million, $1 billion market cap, that kind of thing. Well, what happened is when those new companies went IPO, they issued shares in the market, there was still a lot of growth left in them, okay? There's still a lot of growth to be able to take advantage by these new investors in the public markets. And that has helped over the last 10 years. That's helped growth outperform, right? Because there's been a lot of great names, a lot of great tech names IPO over the last 10 years, had a lot of value still available for the investors in those shares to invest in that IPO or just shortly afterwards and still ride those stocks up. Well, the problem is, and this is really what we've seen this last year, is these companies are coming to the market issuing shares in an IPO, and they're already like 20 or 30 billion dollar companies. Okay, these are massive companies already, with honestly, frankly, much less growth left in the names. Okay, you've got some of the biggest IPOs this year have been 10 million, $10 billion minimum. Okay, there's been other companies that have come into the market with 20 and 30 billion dollar market cap. So there's just not quite as much growth in these IPO names when they come into the market. And I think that's going to hold back the entire growth theme from investors over the next few years. If there's not that much, if all the growth or if all the returns is sucked out of that company by the time it gets to the market by those venture capital players, by the angel investors and that, then it's just going to hold back those returns in growth stocks. Also, though, any economic weakness we see next year is going to hit those growth earnings harder than it does the value stocks, right? Because with growth, a lot of that the stock price is really based upon the idea that they're going to keep on growing those earnings by 20 or 30% a year. And when the economy stumbles a little bit, when economic growth stagnates, then obviously that idea or that premise kind of falls apart a little bit. So the growth stocks come down, and the value stocks do relatively better. So just a few reasons why I think, I think value stocks can outperform in 2021. Likely we're going to see a little bit more inflation. You can't pump $7 trillion or $10 trillion into the economy within just a few months, and not expect to get a little bit more inflation, right? So that's going to drive interest rates a little bit higher. Any kind of a jobs rebound or anything like that will also push interest rates higher. And all this is going to help the financial sector, that traditional value sector, outperform. Energy, obviously, you can't get an economic rebound with a little bit higher oil prices, a little bit higher energy, and that's going to help those energy stocks. So I think, some very good reasons to think that value can come back over the next year. And I want to share this. See if I've got this one in here. So I do. Value. I want to share this last chart with you of what I'm really what I'm looking at for value sectors. And most of you out there in the nation have seen me use this chart quite a bit in the past. This is from FactSet Earnings Insight. Great research tool. It's free. Just go to Google, type in earnings or FactSet Earnings Insight, and the first result is usually going to be their most recent research report, right, on earnings. And these are just the 11 stock sectors plus the S&P 500, right, the stock market index. The dark blue line is the forward price to earnings ratio, right? So the current price of all the stocks in that sector, for example, information technology, industrials, communication services, the current price of all the stocks in that sector divided by the earnings that analysts are expecting from those stocks over the next year, right? So it's a forward price to earnings, not necessarily trailing price to earnings like you normally see out there in the market. But it's basically the same measure, same kind of idea. So that's the dark blue line is the current one. The green line then is the average, the 10-year average on that, right? So the 10-year average price to earnings multiple for these sectors and for the stocks in those sectors. And then I've added the percentage here above with, how much higher the current price to earnings ratio is for these sectors, the stocks in the sectors, divided by the longer term average. And you can see just about every sector is overpriced on that historical basis, right? Right in the middle here about is the current PE ratio on this S&P 500 on the stock market, 39% above that longer term average, right? And then you've got some of the insanely expensive, what I'll call them, sectors like consumer discretionary on the far right here, or on the far left, 98% above that long-term average. Information technology, IT stocks or tech stocks, 66% above. Industrials, 57% above that long-term average. So undeniably expensive there, those growth names, okay? Tech stocks, communication services trading at a 22.4 times forward earnings, undeniably expensive on that growth side. But if you look on the left or on the right here, you've got those value sectors, right? The value stocks. You've got utilities, healthcare, financials, energy. Energy obviously doing so poorly this year that it doesn't even have a current forward price to earnings ratio, right? The earnings for the sector as a whole are actually negative, so you don't have a price to earnings ratio. But obviously, once as energy prices improve, as the oil price comes up a little bit, then you'll start to see that, and it's going to be a very low price to earnings multiple based on where some of these stocks are trading. So the sectors that you're going to be looking at for that value stock resurgence. Okay, so I would look at energy, financial sector, healthcare, utilities, and consumer staples. Consumer staples over here with a 20.8 times PE ratio, still fairly high, but not too high above the 17.8 times long-term average. Okay. So that's the sectors that I'm looking at, the sectors that we're going to be putting into our 2021 portfolio, waiting for that value stock resurgence. In fact, with the portfolio that we started last week, we've already got some of those names in there. We've got Citigroup, Devon Energy, and CVS. I believe all three of those actually beating the market so far over the past week. In fact, I think Citigroup, if I got to check the portfolio there on Stock Card, but in fact, Citigroup I think is something like up 4% versus the market over the last week. So maybe even starting to see that 2021 shift to value stocks already. So it's just some ideas there why I think value could start outperforming on a relative basis over that. So so now question and answer. Go ahead and ask your questions again. Let me know if if you got any questions. I'm going to try to scroll up here and see what we had earlier in the chat. But if I don't get to your question, please ask it again in this chat below, or ask it once the video's done in the comments. I'll try to hit the comments later on. So what do we got? Thoughts on STWD? AMT, a good REIT to buy. Okay, so somebody asked about American Tower, which is ticker AMT. It's a cell tower REIT, and I like the space. With real estate, you gotta understand you can't look at it as one singular sector, right? With real estate, you really have to look at the different property types and the REITs within those. Actually, I've got a chart showing the performance on the real estate sectors. If I can find it real quick for you, but here it is. So let's look at this chart real quick because it's a great question. This is actually the investment performance by property sector and subsector for so far this year through September, and it's by the National Association of REITs, right? And I've highlighted in with a red square here this the 2020 year-to-date performance on each of these, and you can see so all equity REITs, so all the REITs in general this year are down 12%, and obviously that looks horrible compared to I think the S&P 500, the stock market is up something like 7% for the year, right, or 6%, somewhere around there. But if you drill down deeper, you can see a lot of these property sectors are doing quite well, and some of them, obviously not so. But that's how you want to look at REITs, look at property sectors, and really pick your winners out of that. So with the cell towers, they've actually been doing really well. They would be probably infrastructure here. Infrastructure REITs up 14% for this year. I know AMT is up. I know there's a couple of Crown Castle. CCI, ticker CCI, is actually up, I think, as well. And that's another good cell tower REIT. Obviously, with 5G, a lot of the companies have been building out their infrastructure for the last couple of years, so have been spending heavily on infrastructure and building these tower networks. Well, now they get to collect on that, right? Now with 5G coming out, they get to collect on maybe a little bit higher demand and that kind of thing. So I think over the next year, those cell tower REITs can do very well. If you look at some of these others, it really depends on whether you want a rebound name or you want to try to time that rebound in some of these hit sectors like retail. Retail is down 39% this year. Residential even is down 20%. So whether you want to try timing those and you think 2021 is going to be better, or whether you want to keep going with some of those existing trends. One of the trends in REITs that I'm really watching is the industrial REITs, right? And if you look here, industrials toward the top, it's a 9% return so far this year. So far, outperforming the overall REIT market by about 20% there. And it's because of that shift to e-commerce, right? All of the e-commerce, all the online goods that you bought during the pandemic, they have to be stored somewhere, right? And they're being stored in those warehouses, those distribution centers that are owned by these REITs, these industrial REITs like STAG, right? Ticker STAG. They own the warehouses and then rent those out to Amazon for distribution centers, things like that. So great question there, though, about REITs. What else? Apple's cool. Able to buy self out of Fastly as a buy. Fastly, great stock that we actually recommended last November, ticker FSLY. They really benefited from the streaming connections. Basically, they offer those connections for streaming. Did very well. Came down. I think it was about 2 weeks ago. Actually, TikTok is a very big customer of theirs, and with the problems TikTok has been having, they reported less usage of the services than was expected, and the stock came down quite a bit. It was actually up about 136, which I think we were in at like $20 a share last November, which was a huge gain since last November. Came down to about $85 a share. I think it's around $80 now, and I still like the stock. I was actually hoping it would come down more like $75 or $70 a share so I could buy more because I think it's a great long-term stock, but it is, it is a little expensive right here. Like I said, we've been in it. I've been in it since 20 and have been holding. I sold some calls against some of that right around $70 and $90 a share just to kind of hedge my downside on it. If you can see it down to $70, $85 or $70 to $75 a share, I would definitely pick up more for the long term. Right now, though, it's going to be it's just if we see that continuing shift to away from some of the big winners this year, the tech stocks, the streaming stocks, things like that, then you could see it come down a little bit further. So I would wait for maybe a little bit better opportunity, but I think it's a great long-term stock to be in. Okay, I'm just gonna scroll down to the bottom here to see what other questions we got because I'm not seeing quite as many up at the top. 100 plays. Okay, a lot of political stuff in the chat. Come on. I mean, this is if you want to go to Facebook for your political stuff because it's all over there lately. What else do we have? Ford. Some people talking about Ford in the chat. I actually like Ford. I've been in it since about $6.50 a share, right? Over the past this past year. I think that all the car makers are really turning a corner with being able to roll out their new models and move on from the problems they've had over the last couple of years. So I'm in Ford. I'll continue to hold Ford until probably about $8.50, $9, and then I'll probably cover my positions in Ford with some more covered calls. And basically that just cashes me out of some of it with a premium. If the shares don't reach that premium price on the call options, and I keep the shares plus the premium that I collected. If it does go above that, then I've collected that return on the shares plus the premium, and I'm out of the stock. Basically, it's just a way to kind of hedge the downside in a stock that you like, but might be a little expensive right now. See some people talking about ARK. So the ARK funds are some of those kind of the tech and the growth names and kind of the longer term growth stories. It's been really the darling of Wall Street and of investors over this past year. So again, if we do see some transition from that growth theme into value, then they could come down a little bit. I do like the longer term theme on the ARK funds where they're talking about longer term robotics, the genetic engineering, that kind of thing. So they're good long-term funds, a little bit expensive on that expense ratio. So what you might do actually, because I know they don't own a ton of companies in those funds, what you can actually do is just go to the ARK investing website, look through their portfolio, and just invest in the individual stocks that they're buying. Right, that's going to basically give you the ARK funds without the expense ratio. Okay, so a little bit cheaper way to invest in some of these stocks. Matthew wants to know about Exxon. Great question because as we are looking at those value stocks, especially in energy, which are the stocks that are going to come back. And there's really two ways of looking at those oil stocks. I do like the idea of getting in the larger, more established companies, the energy companies, because obviously, they have the better balance sheets, the stronger balance sheets, and debt available to be able to weather this storm and to be able to survive for that rebound. What I'm looking at though is also the cost to exploration, and that for a lot of the names, Exxon is typically a fairly highly price for production kind of company. So they're paying much more to extract the barrels and for that exploration. I think their break-even price for production at Exxon is somewhere in the neighborhood of $65 a barrel. So obviously much higher than where it's at right now at about $40 for WTI for oil. What what I would own instead would be something like a Chevron, ticker CVX. Okay, they've got much lower price production. I think Chevron is break-even price is about $40 a barrel, so about right where it is right now. So they start making money anytime oil goes above 40. I know RDS is also very low down there. RDS Shell. So I would look to that before Exxon. Now, again, there's two schools of thought though. If you're investing there, if you think a rebound is coming for financials, then obviously something that's got that higher production price, maybe the stock has fallen a little bit more, maybe those stocks would rebound a little bit more. Personally, I'm going a little bit more for safety, so I'm looking at Chevron or RDS, which maybe the shares haven't come down quite as much. Maybe the upside rebound potential isn't quite as high. If the sector doesn't rebound immediately, but there's the safety there, right? So if we do get oil prices kind of stagnating there at 40 for longer, then Chevron RDS is going to be a little bit better positioned with their cash flow, with their balance sheet, to be able to withstand that better than something like an Exxon. So it's really all on your narrative. Where you think energy is going to go over this next year. Is it going to rebound quickly and do very well? Then you're going to want to be in some of those more risky names like Exxon and some of the smaller producers. If you think, if you're not quite sure, or you maybe want a little bit more safety, then yeah, you would go with Chevron, RDS, FANG, which is Diamondback Energy, which we have in our 2021 stock portfolio, Devon Energy, which we've got there as well. Now, what else? I had a question on Main Street Capital, and I just lost it. But somebody asked about Main Street Capital. It's a business development corporation, right? They're going to be very high yields on these business development corporations. So they're persuasive with those yields. But you got to understand with higher business defaults, if we do get into economic problems, then their returns are going to be lower. They're going to be hurting. One thing I can tell you, and I haven't looked at Main Street in a little while, I'd have to look at that. One thing you can do when you're looking at these business development corporations, these BDCs that have those high yields, what you want to do is you want to look into the financials and see where they have their average debt yield. Okay. They're going to report this. It's a very important number for these BDCs. This average debt yield is the average or the weighted average of all their loans on their books and what the interest rate is for that. And what you want to do is you want to look at that compared to the dividend yield. Okay, so because obviously if they're collecting 12% average debt yield on these loans, but trying to pay out 14% dividend yield on the stock, then it's not sustainable. Okay, so what you want to do, you want to look primarily or first anyway at the average debt yield on the shares versus what they're paying out to make sure they've got that dividend sustainability. What else? I don't know why Munchin Diamonds keeps on saying bow tie. Not sure. If you've been watching the Sunday shows, I take the bow tie off for Sundays. Let me relax a little bit and just talk to you guys conversationally here. What else? Thoughts on Boeing? Okay, Boeing is actually something I've been negative on for a long time since they've started having their problems. And I didn't short the stock, but it's definitely been a short potential in the stock. I'm actually short term positive on Boeing though. They're set to probably get their recertification in the U.S. for their Max planes. I think they've actually already gotten it in Europe, the certification for that Max craft. But in November, they're set to get recertification back again. I think it's going to be a huge boost for investor sentiment. If we do get any kind of a stimulus from Congress, whether before the election is not likely, but I think just after the election we should get more stimulus, and that will almost definitely have something in there for the airlines. Obviously, anything that boosts the airlines, whether it's a stimulus or more traffic, is going to boost Boeing because that's their largest customers. So you've got plus we're going to get the vaccine, right? Pfizer has said it's going to apply for emergency authorization on its vaccine candidate in later November, third, fourth week of November. So we'll have those basically three news events, new headline risk around Boeing that could pop the shares, right? So I'm actually positive on Boeing over the next couple of months, 2-3 months maybe. So if you're looking for a good trade, maybe you get into to Boeing over that period because I think any one of these three can help the shares, can help support it. What else? But over the longer term, okay, yeah, I need to preface that with over the longer term, I would not be an investor in Boeing. We actually did a video a few months ago on zombie stocks, right? And Boeing's probably the poster child right now for a zombie company. And that's just because they have borrowed so much over this year. I mean, we're talking, I think somewhere upwards of $40 billion Boeing has borrowed in terms of debt. And, it is just going to be very difficult for Boeing to be able to pay that interest every quarter and still grow their earnings, right? So, over the very short period, 3 months, even 6 months out, as we start seeing air travel kind of rebound a little bit, you could see a good pop in Boeing and some stability. But over the longer term, it's going to be very hard for Boeing to make money and for Boeing investors. So not necessarily a short, but I would definitely avoid the shares if if I want to put my money to work. What else? Yeah, a lot of people asking about the individual airlines. Again, just this is kind of similar to the energy sector, right? The airlines. There are the carriers that have fallen further, have higher costs. If you believe the airline sector is going to rebound quickly and very strongly, then you would go with those because they're going to be the higher short-term returns. If you want a little bit more safety, but still some very good returns, okay, then you go with some of the others. Personally, again, I like a little bit more safety, but I'm still going to get those high potential returns in names like Alaska Air, like Southwest Airlines. Southwest Airlines especially has one of the lowest capacity needs in the industry, right? So capacity, the load factor is just what percentage of seats have to be filled on average in each plane for that carrier to make money, right? And what we see is with Southwest, it's down around 70%, right? So 7 out of 10 seats need to be filled on average on each plane for Southwest to make money. And when you compare that to other carriers, especially like American I think is somewhere around 79 or 82%. So not a huge difference, but your money is made on the margins there. And so if we don't get an immediate rebound, a strong rebound in air traffic, and I think it could be years before that, especially the international and the business traveler comes back. Okay, so we're seeing the shift in business travel, which is a huge chunk of revenue and profits for for the airlines. That business travel just isn't there. People are doing the virtual conferences. They're just not going to conferences. That's going to be a while. International travel is going to be very weak. That's about 15% of revenues for most of the major carriers. And internationally, we might get this thing under control in specific countries like the U.S. or around Europe or something, but governments are not going to have the confidence to be able to open up that international travel, right? So, I would be very skeptical on airlines, especially over the long term because of the debt that they've raised this year. But again, if you feel differently, if you feel like airlines are going to rebound quickly, then you would go with American, something like an American. If you think you want a little bit more safety, you go with Southwest. I'm in Southwest. I think they can do well for the same reasons as Boeing there over the next 3 to 6 months. I think they get the short-term sentiment boost on the vaccine, on stimulus, and on just kind of an increase in the economic recovery. But over the long term, it's going to be very hard with the prevailing wages they have to pay, with the debt, the interest expense that they're accruing this week. What else are we looking at? Okay, somebody asking about Apple. Apple's a tough one here. I really haven't covered Apple that much in the past. In my analyst days, I didn't cover it, and honestly, I mean, it's hard to say here because it's so expensive, right? I'm much more of a value investor. Like I said, I think we're going to get that shift, that transition from value to growth. So I wouldn't own Apple. I don't think I would necessarily sell it, just because it's always got that sentiment boost from investors. But yeah, I would avoid Apple for better stories. Uh, Somebody asked about AMC, so the theaters, and again, that's probably one of the riskiest ones for the for going forward. Again, if we do get that vaccine approval in November, which I think we will, then you might get a quick pop in AMC or some of the other theater names. Longer term, I think it's going to be harder. The thing people don't realize is with this vaccine, it's probably at best maybe 60-70% effective. So one, you're going to need at least 2 shots for these. Two, if only, I think something like 40% of people are saying they're not going to get it immediately. They're going to kind of wait, let other people be the guinea pigs on this vaccine to see if it works or causes any bad side effects. So basically, you've got, okay, if something is 60% effective at giving you the immunities to the virus, if only, we'll say, 50% of the population takes it, so that's it's an iterative property, right? I think so 50%, 60, that's 30%. Right, so basically only 30% of the population is going to have that immunity for the virus. Right, that still leaves a large chunk of the population that is going to be getting the virus, going to be spreading the virus, and I think that's after this first 3 months or so, where people are going to be confident, they're going to be going to get that economic boost from being able to go out, thinking they can go out. But then the reality is going to set in. That one, the reality is that this virus is still very much in the population, and causing people to get sick because you've only got that 30% that are now immune to it. And basically, they're saying that herd immunity is around 60% of the population. With how this virus operates, you have to have 60% of the people within a population have the immunity to it for it to stop spreading, on a large scale. So I think 2 or 3 months after the vaccine starts coming out or starts being distributed, people are going to start seeing, well, shit, this is still a really very, very dangerous situation, and they're going to start pulling back from some of that consumer spending like they've done. So that's going to hurt those mall stocks, right? It's that is just a petri dish being inside that mall, with people you don't know. So I would be wary of the mall stocks, at least after this first initial 2 to 3 months period or so. What else? Certain age you have to be to invest. Nope, no age. I mean, typically you'll have to be a certain age to be able to open a brokerage account. Maybe your parents will have to open up an account for you, but you can start investing at any age, any price. Just invest what you can. That's really one of the things I try to get across on the channel is, don't think of investing as trying to get those huge returns, those high double-digit returns every year. Just think of it as a great bank account, a great savings account with maybe a 7 or an 8% yield. Put your money in regularly like you would any kind of a savings account, and it's going to grow. Over 15, 20 years, you're going to have a few $100,000 at least, even on those lower rates of return on that. So yeah, and I mean, I know a lot of you want the 30, 40% annualized returns to get rich quick. Well, yeah, okay, so you get rich, you retire, then what the hell you're going to do? You got to do something, folks. So instead of trying to get rich in the stock market, try to get out of your job. Try finding a job that you enjoy. Try finding a job that you can do over the next 20 or 30 years. Be happy doing it and let your money grow while you're doing it. So yeah, don't don't try to get rich in the stock market just so you can quit work, because you quit work, you retire, you're going to be bored off your ass. You're going to want something to do, and you might as well make money while you're doing it. So find something you enjoy doing for that. What else? I see Bondi's talking about Omega Healthcare. I really couldn't tell you. I don't know. Haven't researched Omega. I'll look into it and maybe be able to get back to you next week or next time we have a live stream. Quan wants to know about the solar sector. Anything renewable, I think, is probably going to do well if your narrative is based on a Biden win or a Democratic sweep of the of Congress, right? Now that's two. There's going to be really a couple narratives there that you have to believe in. One is if Biden wins and if the Democrats sweeps the Senate as well, then yeah, renewables are going to do very well for at least the next couple of months, right? On that sentiment boost, on that investor sentiment boost. They're also talking about something like a $2 trillion infrastructure plan over the next 5 or 10 years or something, with a lot of that going towards renewables. That could boost as well. What we've seen though late in the past is renewables don't do that well unless the oil price is high as well, right? Because these companies, they have to have an incentive, an economic incentive to start building out and investing in these renewables. And it just doesn't make economic sense with oil prices around $40 a barrel, right? So yes, while I do think renewables can do very well over the next 2 or 3 or 4 months, even the next 6 months, right? Because you start Congress talking about some kind of an infrastructure plan or renewables plan. I think they can do very well over the next 6 months. But if we don't get a commensurate rise in the oil prices, then that's going to weigh on renewables and kind of limit the return you can see from that. Okay. What else? I think Walmart was still lots of market share from Amazon. I do not. It's a good question. It's a legitimate question there from Israel. Whether Walmart can steal lots of market share from Amazon. I don't think anyone can steal market share from Amazon. Okay, this is Amazon's world, and we're just renting space. I think Amazon or Walmart can survive. I think what was it? I think it was about 8 years ago, 2012. Walmart, came to the realization that you don't try beating Amazon on Amazon's game. You don't try beating them on e-commerce or on some of this other stuff. You play your game, play it well, and then carve out a part of the market for yourself, for your own company. So I think that's really when we saw Walmart start doing a little bit better against Amazon. I don't think, I think basically, 10 years from now, it's either going to be Walmart or Amazon where you go shopping, right? That's just how it's going to be. So I think both of them will survive. Both of them will do well. And I don't think, I think you can invest in Walmart, but I don't think they're not going to beat Amazon at their own game. What else? Okay, got a lot of questions about Tesla. I won't touch Tesla. I'm sorry. I know there's a lot of huge believers in Tesla out there. You love the stock, you love Elon, but the volatility in the stock is just a little bit too much for me. I like waiting for it to come down 20% or so, and then I'll ride it up for a quick 20%, 30% return. But the fundamentals just aren't there, and I'm a fundamental investor. Okay, I spent 10 plus years as an analyst, as a fundamental analyst, looking at the the financials, and just a part of me says, eventually, especially with GM rolling out their EV truck, right? The Hummer, the EV Hummer they had just announced this week, with Ford, all the major car companies are coming out with their own EV models, right? And yeah, Tesla has a little bit better IP. They've got a little bit better name brand there in EV. but eventually it's going to start trading like a traditional car company. Okay. And that means the price to earnings, price to sales are going to start coming down to that traditional car company values. And, obviously when that happens, then it's going to be dead money or worse for investors for a very long time as that shift starts to happen. Again, not to say that you can't make a lot of money on it here in the short term, trading the stock up and down, but